stop the first recording so that we could split this up a little bit. Okay, so we're back now, and let's now get into trade setups here. And we're going to talk about the first higher high. This is a bread and butter trade setup for me. In other words, I take it whenever I get the opportunity to do so. Here's the euro currency on the 30-minute chart. The overnight data in here makes it a little difficult to read some of the volume characteristics and some of the price characteristics, but you get the idea here. Nevertheless, it's still valid. We see that we've been in a downtrend, and that downtrend has stopped. And we've broken, in fact, the downtrend, the supply line here, and have gone sideways. And we might have put in a higher low here and a higher high here, but then we made a lower low at this point. And we're sort of in here, but we've got a higher low. And now as we start coming up, and I've numbered these bars here, you can see bars 1 and 2 and 3, which is this bar, all have pretty decent volume on them, and all are nice widespread up, creating that first real higher high, that first swing high. We had a higher high here, but then we also had a lower low, so that doesn't count for us. Also, I marked these bars here in X. These are down bars, little down bars, narrower spread, smaller volume. So you get an idea of how to read these price bars and volume here. Each of the pullbacks on this time frame had no supply. Each of the bullish type bars, the up bars, had good demand on them. And we come down here and we have a pullback. Now the market, we have the US Open occur here, so the volume is definitely going to increase. Well, we come down here at A, and we have a little spring, meaning that we have a support level here, and we rally up off of that support a bit. Market comes back down, retests that support by dipping underneath that support level, finding no supply there, and pushes back up and closes above that support. And that's what we call a spring. And this is a nice first higher high setup. We are now starting to see an uptrend take shape here. Okay? And at A, we see good volume come in, but the market fails to go lower and instead springs this little support level. That's an indication of strength in itself. And so we're putting in the first higher low here, or maybe the second higher low, but we've got that first higher high level coming in, and we're putting this this buy opportunity here, and you can see that the market begins to take off from there. So that's that example. Some other nice examples will come in here as well. Again, now this is the S&Ps on a 9,000 tick chart. We're coming down in a downtrend, and if we wanted to, we can draw that little shortening of the thrust type notion here. That's wrong. We can also see, now I've got wave volume in here. We talked a little bit about that. Now I'm using a tick chart in here, and I like to use the wave volume with the tick chart. I'm not showing the Weiss wave itself because I can pretty much read that, and I don't generally have it on my charts, but I do have the volume on my charts. And we can see that with each successive wave down, not only are we getting shortening of the thrust in here, but we're also seeing diminishing volume. Okay. Market rallies, we get good spreads going up. It's kind of in the overnight, so we're not getting lots of volume coming in. But we put in a higher high at C over A, and we break that downtrend line. We come back and we don't see much volume coming into this at all, and we start to see the key reversal type bars start showing up in here. And anywhere in here is a fine spot to take along. But the idea being that the downtrend is over, we've broken the line, we put in that higher high, there's a sign of strength that comes into the market, and we look for that narrow range. I mean, compare this to this, right? We're just not getting the same kind of movement down. It's disconfirming the presence of supply, and then we start rallying up higher. Now at D, we get another high in here, and the market just basically goes sideways. We get good confirming strength coming in, and that's another buy point in there. Okay. And that is a higher high from swing A. That's right. That's right. You can be more conservative about this. You may feel that that's not a great swing high here. And really the last swing high, the last serious swing high is at B. So therefore D, if you want to be more conservative, you can certainly do that. D then would serve as that first more conservative higher high. It's coming up on a good sign of strength. We're getting actually larger wave volume. That's partly a function because it's near the open or in the morning session. Well, stop. You can't do that. Sorry, the dog wants to go out here. And he locked himself in. So we're getting good strength, but we're getting some good volume here. Partly a function because it's the morning session, but also it's not pulling back on all that volume. Something we call effort to go down with all this volume, but there's really no result in terms of price. Price is not moving freely down. We would expect ease of movement down on all this volume. We're not getting it. So this is also a more conservative spot to buy. This may be a little bit more aggressive for some folks, but then you'd want to add to your position in here as well. So good comment there about that. All right. Sonny says it's very similar to Jump of the Creek. It can be similar at times, but let's take a look at this. This doesn't necessarily have to be the jump across the creek, although it will often set up on that type of a setup. So here we have a last swing high at A. It gaps down in the morning. This is a 5-minute S&P chart. And we find support down here. And there is some shortening of the thrust as well. If we were to run that line down, we would see that. No question about that. The last low is here, and then here, and then down here. So we're getting a little bit of shortening of the thrust. Market starts to push up. On the down bars, we see lighter volume come in. On the up bars, we see stronger volume coming in. It makes even a small little high above the previous high. We've closed the gap in here. We've rallied up pretty good. We're seeing that volume coming in to the upside. And then as it pulls back, we get very low volume here. We get that key reversal, and that's a spot to enter long. We have to sit through a lot here, unfortunately, but we don't really get a lot of volume coming in as it returns back to this level, and then we finally get the demand entering in an aggressive way, and then we sets up a trend day to the upside. Gap down, we are open basically on this extreme, and then we rally all the way up. First higher high. Here's first lower low. We're in an uptrend. We have some supply come in, lack of demand. First lower high in here. We pull a lower low, or we get a not quite a lower high here, but we get lack of demand at B. A lower low, we rally up. This is the first pullback after the trend line has been broken, after we have that lower low, and it's a good spot to take a short, and it continues to go down. This is the pound on a 4-hour chart. And just to give you a And as we rally up, you can see there's light volume in here, and especially at E, probably in the overnight market just before the London session opens for the pound. This setup, I forget what day this was. This was earlier, the 21st, so I guess it was a couple of days ago, Thursday maybe. We have a low at A in the overnight market, unable to make new highs here. We come down. Now here's where the Weiss wave can be of some significant value to us. We see a large increase in downside volume. Okay, spreads are pretty good coming down. We try to go up, but we just go sideways. We have that little upthrust type of setup that occurs, and then bang, we're in a trend day to the downside all day long on that first lower low. And again, it doesn't need to make a huge low. We have enough weakness in the background telling us that this market is weak and it wants to go lower. So criteria on this. For the first higher high, we want to see that previous downtrend ending. We typically see shortening of the thrust or a climactic action, then a break of the trend line, a large up wave as we've seen, or a large demand coming in. The higher low occurs, and so forth, right? We see ease of movement up. We've talked about this now several times. Spreads, closes, and volume are all important on that leg up. We create that higher swing high, and then the reaction has lighter volume, narrower spreads, and overlapping closes. And whatever our entry trigger is, I tend to like the key reversals, but you know, there's different ways to enter that. Sometimes a spring is good, sometimes you know, depending on how you want to structure it for yourself. First lower low is just basically the opposite. The uptrend is ended. We have ease of movement down. That the lower swing low, and that rally has lighter volume and narrower spreads, and we look for that entry trigger, typically a hidden up thrust, which is a key reversal or up thrust, at least the way I like to do it. If I short at the arrow, where is my stop? Generally at the high of the bar. Okay, so in other words, if I go long here, let's say I go long here, then my stop is going to be typically right at the low, because usually if they're going to take out the low, then they're going to take, you know, they're going to go down. Jump across the creek. This is a classic Wyckoff trade setup, and the reason why it's a classic Wyckoff trade setup is because a consolidation, a lengthy sideways line of trading, sets up an opportunity for larger traders and smarter traders to accumulate a position, okay, accumulate a line of stocks. They buy in here, and in here, and in here, and in here. So they move the market up and down in the trading range, okay? This is probably the best trade setup, and sometimes we'll see this as a first higher high. In fact, this is a first higher high here, where we jump up across this creek of supply. The story comes out of Wyckoff, it comes out of Bob Evans, and he was actively teaching the Wyckoff method in the 50s and 60s, and at that time in the United States, Boy Scouts were a big organization, still are pretty big, but they were very popular then. And so he tried to make, you know, give traders stories that would help them understand the market. And so this is about a Boy Scout who's walking along and sees this river or this creek, and he wants to get out here someplace. This is his objective, but he's down here, and he walks along and he sees that the creek is too wide, so he continues along and follows a path and comes up against the edge of the creek again. Too long, too wide here, too swift, the current's too much. So he comes down, walks along the path a little bit longer, comes up and still too wide, but sees downriver a little bit that it's really narrow down in here, and so he thinks that if he can get a good running start and he could run really hard and jump across that creek. And he does, and the jump kind of takes them out to here. He's got so much momentum. But what he does is he comes back and he takes off his boots and sticks his feet back in the river at the edge of the creek before going on to his objective, to his campsite. That was the story, okay? And the idea of the creek here is that it's a creek of supply. This is where the market stops. We have supply here and here and here, okay? And the jump across the creek will generally look like this, where volume comes in, the spreads are larger. It's a sign of strength, okay? A sign of strength. It's always preceded by a downtrend of some sort. And here we can see that we did get oversold in the downtrend, and then we broke the downtrend channel. So the downtrend is over. And then we go into this protracted or lengthy trading range, and we see a sign of strength that pushes us up to new highs. And then we get that retracement back to the edge of supply, which should now be resistance. It's, again, like calling out the sellers. Okay, you were selling in here and here and here a few months ago. So I'm going to bring it back down. The market says I'm going to bring it back down to that same level. Are you going to come in and sell in here? And they're not. They're not selling it. And so the market wants to rally up from there. So that's jump across the creek, okay? And yes, again, it can overlap with the first higher high. And you can see I put in some arrows here for the price spreads and the volume where they come in. And then again, as after A, we would probably want to be buying, if you're doing the key reversal type of bar, you'd probably want to be buying on this bar here, and you can see that the volume starts to come in and drives the market up. So that's confirming that demand is still there. We get the disconfirmation of supply, and then the confirmation of buyers or demand returning into the market. Okay. Now you can coordinate this with the higher time frames, and it's a very good idea to do. I haven't talked too much about that, and I want to start to get into that now. So here's the weekly chart of the S&Ps, and we can see really good demand had come in here at the green arrow with volume increasing on that demand. And then we've pulled back, and this is something markets tend to do. They tend to come back into areas of acceleration like this. But look at even on the weekly here, this is where the market jumps that creek on these 2 weeks here. And then the pullback to A. Okay? And you can see it's nicely set up on the weekly chart as well. And even on the monthly chart. Just look at this one bar here that I have the arrow on. That's the jump, right? And it comes back to the edge of the creek, which is the previous month or so, and test that before going higher. Okay, so you can see this on the higher time frames as well. And here on the monthly, we've got a spring that's occurred. Remember I said the market comes down and creates a support level, rallies up, and then comes back down, can't penetrate it, or penetrates it rather, but can't stay under there, and springs back up above it. Sometimes we'll see a test of a spring, and that's what we're seeing here. So we can coordinate a test of a spring with a jump across the creek, a test of the spring on the monthly chart with a jump across the creek on a daily chart. Pretty nice. Pretty nice. Okay. HFT, Gajendra. Is that how you would pronounce your name? Am I getting it fairly close? Gajendra? Good. Okay, good. I want to make sure. HFT, Gajendra, means higher time frame. Okay, higher time frame. Would I have entered on the first pullback before A? Let's go back to the daily chart. Back in here, probably. I might have, yeah, I might have. And then I would have been quick to exit out when I saw that day there, because I realized that we are now going to come down here in this little trend channel. I'll wait till we're oversold here. And by the way, we have a little spring here too, don't we? Let me erase so you all can see. We're going to talk about this kind of a setup here, but this is a choice trade setup where we dip underneath this support and we spring it right here. Springs are very powerful, and now I'm showing you combinations of chart patterns where we're jumping across the creek and having a spring at the test of a higher time frame spring, which is just very powerful stuff. Okay. All right, here's jump across the creek on a very small time frame. This is the 3000 tick bar chart with the wave, Weiss wave in here. You can see that we've been actually in an uptrend of some sort. Then we're going sideways for quite a bit. Any down move seems to have stopped. We have that sign of strength occur here where we're jumping across the creek, and the creek is somewhere in here. And again, we get that little spring type setup. See that? Even on a 3000 tick chart. And the Weiss wave helps us to see that not only do we have the biggest wave going up, but we also have the largest volume coming in for that. And then as the market dips back down, look at, we get a little bit of supply here on this wave down, and then this wave is here, and there's no supply. Okay? Picture perfect. So it happens on the intraday as well as on the daily and weekly charts. Here's a 9,000 tick chart of the S&Ps. I mean, it's the market that I trade an awful lot, so you're going to see mostly examples from that. We're in a downtrend. Same kind of thing. We get a little spring here. It stops. Sign of strength occurs. We push up above the creek of supply. And if we drew a line here, we're even above B. So this is kind of nice. And also, here's something I look for. You know, we break the right here, we get oversold in the trend channel. And then we break that trend channel and we put in that nice big wave up, that first big wave, biggest up wave since the downtrend began, something I'm always looking for. And then I'm looking for the market to hold this support level, and then we get the jump across the creek. Very nice. And then we get a key reversal bar to enter on. We don't always get springs, but we get that key reversal, and it's a good one. This is, as I say, gives traders an opportunity to go long in here. This becomes a buying zone. And this is typically the result, that we run up and notice that we go all the way back up to, I guess this is yesterday's or the 2-day high here. A nice little target. And again, you can draw your trend line in here, and you got pretty nice move all the way up. And I'll show you some stuff using the EMA in a little bit on the intraday, because I'm assuming that most people in here are day traders. Here I've really crunched this tick chart down, and this is fall through the ice. Now again, a Boy Scout story. Now this is a story of supply, where a Boy Scout is walking along a river, and now it's in the wintertime and it's frozen, and he's walking along here and the ice supports him pretty well. He kind of wanders off and then comes back, and the ice supports him here. He wanders off a little bit, but now bang, he falls through the ice, right? And because there's a little current here in the river, he gets pushed downstream and he tries to get back up, but he can't. He's bumping his head along the level of the ice. And of course, he does not do well, and he drowns and comes down. And that's the story of supply here. And you can see that not only do we have a fall through the ice at this point, and then the return, the bump the bump against the ice here, but this also is a little bit of ice, and we fall through it again, and we come back up and bump. So you can use that same analogy, and then here we are again, we fall through and bump back up. You can continue to use that analogy all the way down. Okay. This is a nice short trade setup. So this, again, kind of coordinating this with the higher time frames, that 45,000 tick chart is an intraday chart, and here is the same chart Same location, here we are on the daily. You can see the sign of weakness in here with the increased volume. And here we are on the weekly where we put in a lower high, and then the question is, are we going to make a lower low? And by George, we are. We do. And so we can coordinate the time frames with that. And notice, here we are here, and we've got that key reversal after a push down and then a kind of a weak rally back up. So good odds that we're going to see some downside here. This is the current S&Ps. FTI is fall through the ice, Amy. Fall through the ice. You like those stories, huh? Yeah, again, it was the Boy Scout kind of story. Here's an interesting chart that I liked. This was a nice trade. This is the May 6th flash crash, where we really fell through the ice big time. And then we came right back up, bumped our head here, have a little key reversal, and we come back down, and all that volume had to be tested. And we did. In fact, we made a little bit lower low before going up higher. But that was a nice example of this as well. Good, Dean. I'm glad you're getting something out of it. We will, I think I have an email. No, I don't. That's somebody else. I've got Darren. I've got to answer an email. Take care. We'll see you later. Dean's got to leave a little bit early. Here's another example. This is cocoa on a daily basis. Again, we've got this trading range in here. We're making lower highs all along. This is pretty clearly weak, but we found some support. Then we drive through it. And then look at, it's that sideways action, just showing, and unable to get up higher here, just showing that there's continued weakness in the market. We're looking at the same thing in a lot of different ways, or similar things in a lot of different ways. And I'm doing this to get the concepts across. The concepts are, the basics that we talked about earlier on are what are really the most important things. The ease of movement, the volume coming in, the higher highs and lows, or lower lows and lower highs. The narrow spreads on the pullbacks. And then the trigger points. And if we can connect that with support and resistance, that's what we're doing here on the jump across the creek and the fall through the ice. The only thing we're adding to this is the lengthy trading range, because that's giving us more cause, if you will, more opportunity for the larger players to pick up inventory. That usually leads to a larger move. The consolidation is the important thing in the jump across the creek and the fall through the ice. Okay, the more consolidation we have, we will see typically a bigger move ensue. All right, so that's the criteria. I think that's all pretty straightforward. All right, let's take a look at some other choice trade setups. These, I tell you, I think they're pretty close to gold. We've seen them before. I've introduced them before, but let's just take a look. Here was Friday, ended right at the arrow here. This is a 27,000 tick chart, probably about a half an hour to I don't know, somewhere between 20 and 30 minute chart on the S&Ps on a good active day, and we had that good active day occur. And you can see we were in this kind of what we would maybe call an apex formation in here. We broke down through it, big volumes coming in here, one little pullback in here with no volume on it, and no real price movement on this time frame. And then we get this ABC wave, okay? ABC, it's a three-wave idea. The first wave up is a little impulse, then a little pullback, and then a little more of an impulse up, okay? It then fails and comes down. I often connect this with upthrust because that's the way I visualize it. But this really comes from Elliott wave theory, this three-wave correction. Now, Elliott talked in terms of impulse moves and corrective moves, or motive moves and corrective moves. And motive moves are always going to be 5 or maybe sometimes 7 waves up. Correctives, at least the simple ones, the ones that I can see in the market, are going to be 3 waves. I can't read something like this out of Elliott. People can do it, I can't do it, so I don't really try, and I surely wouldn't try to teach it. But I'll tell you that when we have a good solid move like this, and then we have this corrective 3 wave, I am looking for that upthrust in here for a trade lower. Okay. And here we are. This is kind of a fall through the ice type of scenario here. Here's our ice. We break down through, volume increases. Now we have that corrective 3 wave ABC type pattern up. It forms a little upthrust. This is an upthrust at resistance in a downtrend. Really quite nice. Really quite nice. And we would definitely expect a new leg down here. Okay. What distinguishes ABC corrective from first higher high? Well, you don't have to have a 3 wave up for a first higher high. They're really 2 different things. You can have an ABC that makes a first higher high, but it doesn't have to. Okay. Do I ever use Fibonacci with ABC? No, I used Fibonacci for a while. I looked at that very carefully with Joe DiNapoli's work, which I thought was good, because he's kind of creating a multiple time frame scenario with his Fibonacci, but I still couldn't really make it work. I'm confused as to when you do and do not use tick charts and when you do and don't have the Weiss wave on your charts. What do you recommend? I mainly trade the ES. Well, if you're trading the ES intraday, I would use the tick charts, and I do that exclusively. My screen, when I'm looking, I've got a 27,000, a 9,000, and a 3,000 tick chart on my screen of the S&Ps, the ES. And I also keep a 5-minute with standard volume and New York Stock Exchange ticks, because I've used those for a long time, and they are helpful in trading the S&Ps. But that's the only standard bar chart a standard time-based bar chart that I keep on my screen. And the reason for that is because you cannot put tick charts in a tick chart. They don't allow multiple symbols. It's a limitation of the type of chart. And it probably will never be changed. But for intraday trading, I use almost exclusively tick charts. By the way, this is the U.S. bond, the 30-year bonds. And this is a really choice trade setup that we're looking at here. Here's Hewlett-Packard on a daily not too long ago, a couple of weeks ago, in fact, 3 or 4 weeks ago. Big, strong gap down, big move down, big volume coming in on that move down. We get that little ABC type pattern in here. Again, an upthrust at resistance in a downtrend. Okay. So another way to think about this is that it's an upthrust at a fall through the ice, if you want to think about it that way. Okay. Where do I find tick charts? I can't find them on AT charts. I'm not sure, Richard, what AT is. If that's a charting package, I'm not familiar with it. You'd have to check with them. Here's spring at a support in an uptrend. Again, this is kind of like the jump through the ice type story. But here we're adding the dimension of an ABC type pattern with a spring where it dips underneath this support level at A, the A swing down, and it doesn't hold there, and it won't hold there because of this stuff there. Well, it could continue to go down, but we're looking for it to hold there, and when it does, we know that that's pretty good. And then we see nice movement up, a little consolidation, and more nice movement. And that's exactly what we look for. And that's XOM on a daily chart. Look at this one. This is DuPont. I mean, sleepy old do nothing DuPont. Same kind of thing. Springs at support in an uptrend. Now here, it kind of that jumping across the creek type of trade again, right? Trade setup again with that ABC pattern. But then look at what, and we get nice movement up. But then look what happens. We're in this good uptrend. We've got old resistance right here on this little sideways action. Not much resistance, is there? Not much selling, because we're just going sideways. And so we push up, and it's kind of choppy in here. We make a low here, right? A small swing low. We try to go higher. We come back down, and we get a spring right here. We dip under that low and then back up above it. And it's on top of this old resistance, which now should be support, which is. And we test it once or twice, but anywhere in here is a good spot to take a trade. We rally up. Again, we put in a low. We're testing that resistance level here and here. Resistance is an area. It's not really a line, although we represent it as a line. And then we come down and we spring. And we're at support. And that support level really is something like this in here, that support area. So we spring the support once again. And then it gets tested and off we go. And that's DuPont. Okay? Now, if we were to, let me just make this comment here. If we were to try to place a trend channel up, notice how we would start to break it here. And then we maybe, well, let's adjust it. And it doesn't really tell us, okay? When I think about support and resistance, I do use the diagonal, but I'm more interested always in the horizontal support and resistance levels, especially when they just go sideways like this, sideways like this, sideways like this. No real pullback, okay? No real pullback. So even just people don't trade this stock that much, but you certainly can see this pattern occur over and over and over again. Springs at support, and that's what we want to do. That's what we want to look for. And we see them a lot of times at the jump across the creek, but it's not only there. It's not only there. And the same thing is true with fall through the ice. Okay, a bunch of questions here. Oh, not that many, actually. To use the Weiss wave, do we need to use the tick chart? No, you can use, Gajendra, you can use it off of a regular time-based chart. Sierra charts, I don't know. I've never used it, Richard. I wouldn't have the foggiest clue as to how to do that. Martin asks, is that a spring at the gap up move? The gap up move. Okay, let's see. Where, over here maybe, are you thinking? Well, I can probably, wherever you're thinking about the gap, the answer would probably be no, because a gap isn't a swing low, just to the right, yeah. Okay, just to the right here, yeah. No, what we need, a spring needs to come down, make a swing low, rally up, and come back down and revisit that low. Go underneath of it and then close firm on top of it. That's a spring. So gaps don't really factor into a spring. Okay? Okay, good. You got it. Great. Will the Weiss wave work on VRSRT charts? Is that real time? I'm not sure what VSR is. I think David now has it for TradeStation. We have it coded for VSA. No, they're doing that though, Mark. They're putting it in VSA. They're putting it in VSA. But we have it for TradeStation, Ninja, and I forget one other one too. Okay. All right, so let's push on here. Now I want to show you a little bit about how to use indicators in in trend trading, and this can be helpful for a lot of people if you know how to use them correctly. All right. And the ones that I'll only show you what I know. I don't use the MACD. I don't really use the RSI or anything else like that. What I know is I've been using the 310 oscillator since the year 2000 or 1999 actually. So that's the one I'm familiar with. I'll show you this tonight, and I'll show you the Weiss wave, and we'll do a little bit more on the exponential moving average because it helps to use the EMA with the 310. Okay. All right. What's the 310 momentum oscillator? First thing to know is the name, momentum oscillator. It shows the momentum swings or cycles in the market. Okay. That's what this thing is designed to do. Nothing else but do that. And it does it exceptionally well in a trending environment. And I'll show you how that works momentarily. Just a quick construction of this. It's a 3-period simple moving average minus a 10-bar or 10-period simple moving average. Okay, that's known as the 310 line. That's all it is a 3-period simple moving average, and you subtract from that the 10-period simple moving average, and you plot it. And that's the green line. Sometimes we call this the fast line. And this indicator is very sensitive. It jumps around a lot. Okay. The 16 average, or some people call this the trend line, which is not a bad way to conceptualize it. This is constructed by summing the last 16 310 values and dividing them by 16. Simple as that. Okay? So this is very, very far from price. It's very derivative of price. Okay? But the dang thing works pretty well. And I'm not going to go into all the details of this because it'd take too long to do. You can see that the level of thoroughness that I try to go through in this stuff. So how we use this and how we're going to talk about using this tonight is to think about when the 16 line, the 16 average is above 0. Okay, here's our 0 line. When it's above 0, means the market is likely to be trending up. And so when the fast line, when the 310 pulls back, because remember we want to buy on pullbacks. Remember the very first thing we said is in the basic idea of trading a trend is to buy pullbacks or sell pullbacks. So when the 310 is above 0, the market should be trending, and we want to buy pullback when the 310 gets below 0. Okay? We never want to buy up here. Okay? We want to always buy when the 310 is below 0. But we really want to only buy when the 16 average is below. And vice versa for sells. When the 16 average is below 0, the markets should be trending down, and we want to sell when we have that 310 pullback. Okay? That's the basics. Simple. We only want to do things simply here. Okay? So let's just take a look at this. Simply, how we can do it. And this is on a 3,000 tick chart. Okay? And I've marked S's and B's, sells and buys. Okay? So it seems like the market's coming down here, and sure enough, our 16 average, which is the blue line, is underneath 0. And it's been hanging there for a while, indicating that that trend is going along. And now suddenly not suddenly, but the 310 pushes up above the 0 line, which is in the middle here. and we get a reversal bar, and there we go short. Okay. Now we don't get a huge amount down, but we get a new leg down, and then we get a sign of strength, right? Doesn't this look like a first higher high to me? Yes, it does, certainly. First higher high here. Okay, it's not a jump across the creek or anything, but we have momentum coming in to the oscillator, and the 16 line is now above 0. Very nice. We can draw a trend line across that support level. Notice that the 310 comes down below the 0 line. We get that key reversal at support. There we go. There's a nice trade to the upside. Okay. So it's important to use structure and be able to read what we've been doing. Please don't do this. Please do not. What I'm going to show you is very powerful with this indicator, okay? Especially when we use it with a combination of the moving average and the Weiss wave. And everybody, I know you are all going to feel like, maybe not all of you, but many of you are going to feel like, well, the heck with the first part of this tutorial, let's just use this. You're going to gravitate towards that. And if you do that, what you'll find is that you'll get hurt by doing that. Because, look, for example, here's a buy setup over here, right? We've got the 16 average is above 0. And, think about this. We're on the live edge of the chart, right? 16 average is above 0. 310 pulls back. We get that key reversal. Let's buy that thing, right? Let's buy that thing. Except we just had an upthrust here. Okay? We want to be a little more cognizant of what's going on in the structure in the background and not just take this stuff blindly, because it would be very easy to do, to take this blindly. And I know it's going to be very enticing for people to do that. But please don't do that. Please don't do that, because you'll find that that's not a smart thing to do. You'll get hurt doing that. All right, enough of my soapbox. Oh, while I'm on the soapbox, let me just add one other thing. Do not, and I'll repeat this, do not look for divergence in this indicator, in this tool. That's the worst thing you can do with it. In fact, it's the worst thing you can do with any momentum tool. But particularly this. Don't do it. Okay? Gajendra asks, is the 16 average a simple moving average? Yes, it is. It is a simple moving average. And Amy asks, is that the 20 period exponential moving average on this chart? Yes, and you can use a simple moving average, but I've always used an exponential. It just is a little quicker. And we're gonna use this in combination, and take a look at how to really use the indicators and use them properly. Okay, so let's take a look here, and you can see we've made a lower low here. Here we're on actually a fairly choppy looking couple of days here on the 10-year notes, all right? But just to show you that this thing works pretty well in a choppy day, we are getting a lower low. We pull back here, and notice that the 16 average of the 310 is below 0. And you can see that it cycles. If you look at this carefully, it cycles along with the market. It's a little slower than the market, and that's a good thing. But it does cycle pretty nicely. And that's what it's designed to do, and it does its job very well. So we get the reversal bar here when the 310 pulls up above 0, and then we get rewarded for that, and we get a new push down. And you can see that the 16 average is coming down even lower than what it was at this level, indicating that the downtrend is deteriorating. We get a pullback to 0 here at 2, and we get weakness coming in, so we can take that. And then we get another pullback here to 3. Same thing, we're under 0. Even though it's starting to rise up, it's still okay. But what it's suggesting is, as it's rising, this is what you want to be looking for: shortening of the thrust, which is exactly what we're seeing. So as it's rising, we want to think about playing small now, not looking for a good solid push down, but maybe just down to the low here, okay? Suddenly we make a higher high as we open in the next day. We start to pull back here. The 16 average rallies up. We pull back to 0. There's a buy opportunity on that key reversal. Now, let me make a point here about the exponential moving average. Notice how it's moving up here. Notice how it was moving down. And notice how price comes back to that area. So the combination of this and this and this and this, with the EMA moving and the 16 average being consistent with that, is a nice little way to think about this, okay? You want to have all of your ducks lined up. The most aggressive trade on this chart is number 1. Why? Because the EMA is flat from an indicator perspective, and truthfully from a price bar perspective as well. I don't know what the Weiss wave would look like here. Maybe we saw more supply come in, but just looking at this chart like this, as it is, this is not a good, I wouldn't take this trade. It's not a good trade, okay? But 2 and 3, very nice trades. And then as we come along here, 1 and 2, you can see that we pull back and we're up. And again, as this is starting to roll down, we want to be thinking about smaller trades, and we're seeing that shortening of the thrust start to come in here, okay? So that's how we look at that. That's how we look at that. And you might have taken this here thinking, okay, we're back down, and take that trade, and it doesn't go, it maybe stops you out. Okay, it does. You know, we're at a high point in here, and we're seeing some shortening of the thrust. We haven't had much of a pullback. Doesn't mean that we can read this all that clearly all the time. Sometimes we're going to take losses. This is not perfect. But I would also suggest to you that we're starting to go flat here on the EMA, and we're also starting to really come down on the 16 average, whereas before everything is in sync here, okay? Everything is in sync. So that's looking at the 310. A couple of questions here. The slope of the 16 important or only above below 0? Ahmed, the most important is whether it's above or below 0, but as you can see, if it starts to, you know, really begin to, let me say it this way, the first pullback here is not that material, but if it's persistently sloping down, then it's not a good thing. Then we know that this uptrend is about to end. But better that you can read that shortening of the thrust in the price bars and use this as a secondary indicator, a confirmation. Lars says, after a pullback with the 310 line, do you also use the 310 for entry timing, or do you only use price action for that? Mainly just price action. I mean, certainly this is telling me it's time to take a trade, but here's the entry, right? Here's the trigger. Good question. All right, so now let's add some juice to this, okay? Let's add some juice to this. And the juice is going to be on the higher time frame. So here, I should have blown this chart up, but it's exactly the same chart as before. It's the 4,500 tick chart, okay? Now I've gone up by a factor of 3 to a 13,500 tick chart. And what do I see? I see my 16 average line falling down, trending down. I also see on the higher time frame that 310 is almost in the whole day is entirely under the 0 line, indicating negative price movement. Just the opposite's happening here, where the 310 is above 0 and rising, and then that eventually pulls the 16 average up as well. Okay? So what I'm suggesting is that when we're looking at the smaller time frames like this, we can read it pretty effectively. But the real juice or the real advantage is to combine higher time frames. And if the higher time frame is coming down, then the lower time frame is going to be safer to trade in the direction of a trend down. Okay? And vice versa on the way up. Okay? Very, very useful. We'll see some more examples of that as we go along. Okay, and here's one. Now, again, using the bonds on a 4,500 tick chart, look at A. We are underneath the 0 line, and our EMA is coming down. We are getting a little bit of a pullback up here in the 16, but it's not a big one, not something to really think too much about. We get a nice pullback up. We get that reversal bar. What happens? How come we're not going down for a new leg? Why is that dying out? Anybody have an idea? Anybody have an idea why that might be happening? A little shortening of the thrust, yes, there is that. So we would kind of think about that. But what else might be happening here? An ABC pattern, definitely there is. We've got an A, B, C, okay. Oversold in the trend channel, probably true. We are a little oversold there. All good. And that's probably the best answer here. We are oversold. So if we're oversold, we're expecting something different. Let's take a look. Here's that same chart. Here's A, and then what happened here. But I also put in B and C now. Okay. Look at the higher time frame. What's happening? Well, the 310 on the higher time frame is starting to move up. Okay, it's pushing up nicely. But what's it doing? It's forming a cell, an oscillator cell on the higher time frame at B as the 16 average comes underneath 0. Okay? And then at C, where we get another oscillator trade here on the smaller time frame, we are definitely in the moving down here and starting to move the trend to the lower time frame. Okay, everybody see that? So often, here's the tip, or here's the trick on this. When we see an ABC on the smaller time frame, that is very frequently an oscillator setup on the 310 on the next higher time frame. Okay? It's a nice little, if you're going to use this indicator, you want to know how to use it. And that's the beginnings of how to use it, at least. In a trend. In a trend. That's what we're talking about. Okay, I kind of went through this, so I'm going to just do this really quickly. You know, up waves are larger here on this leg of the Weiss wave, and we get good volume in here. Then the down waves start to increase, and we get larger down waves. And that's what we're going to be using this for. Here, the up waves decrease, okay? And we see suddenly volume coming into the downside. So here might be a trade short. This would be an A, B, C trade here. This would be an oscillator trade on the 310, and we also have one of those up thrusts. We would be looking for a new trend down, maybe, but what happens? We break down below, but then we hold, and then we rally back up, and we get a big wave up. So it doesn't give us downside momentum. But that's in part how we would be using this. Okay, so let's take a look at using these indicators in conjunction with one another, which I think has some real value here. Okay, so here we are on a 9,000 tick chart, and what are we seeing? We're seeing price going down. We're only seeing little small rallies, right? We're seeing, notice this too, that the 310 is completely under 0. completely under the zero line. That's an indication of a trend to the downside, a strong trend. Not only is the 16 average underneath the zero and stays underneath all day long, but for the most part, the 310, we only have one little pop up there. There was the only 310 trade on this whole chart. As you see, though, the volume is light to the upside, and we had big, strong down wave. We saw this chart before, and I mentioned that you're going to see this, that this was a first lower low and then this pullback. Well, now we can add the oscillator to it, but most importantly, we see supply coming in on this wave down. Okay. Let's look at the same day here and look at the next smaller time frame down. Often this is what we want to do if we're going to use the 310. We want to watch, the 9,000 might be the main trading time frame, but we want to watch the 3,000 chart as well. And you can see that, I want to see where we are here in terms of how I structured this. Okay. Yeah, what we see here is the EMA is just going almost straight down on that nice 45-degree line the whole way down. Now, somebody asked about shortening of the thrust. And can you see it and distinguish it from in a downtrend? You'll see something start to pull up in these indicators. Either the EMA will pull up or the 16 average will pull up. And when you see this just this EMA just grinding down, this is like, and we also talked about trend lines. It's kind of hard to draw it with this tool, but at some point this is outside of the trend line. And where do I put this? The trend lines aren't always the easiest to draw on a trend down, believe it or not, on a trend day down in the S&Ps or in other markets. So often it's just easier to use the EMA. And so we see the EMA is down, and for the most part the 16 average is down. Okay. So we can look here and we can see at 1 there's an oscillator trade. The 16 average is below 0. The 310 pops up. It's preceded by a nice wave of volume to the downside. Supply, look at the upside volume. I realize it's the overnight, but look at the upside volume. There's nothing much there. And then this downside volume, and then as it pulls back, look at the minuscule upside volume. So there's a trade. Same thing at 2. It's preceded by a large downside before the 310 pulls back. We don't have much upside volume, and so we get another push down. But that 16 average is starting to climb, so we have to be aware that that's occurring. And if we're not looking to trade all the way down, we also are kind of at support in here. So if we're not looking to trade all the way, we don't know maybe that this is a trend day yet. So we want to be cautious about that. And we get another pullback, and the 16 average goes above the 0 line, although the two up waves here are not huge. And this is a little ABC pattern. And I labeled this as A. Remember this A here, okay? We break down below the lows. Look at the volume that comes in. The first pullback, we have a nice oscillator trade. Another one here at 4, another one at 5, another one at 6, all preceded by good solid volume to the downside. 7, same thing. Notice here we get some increase in volume. We're getting towards the end of the day. So maybe some buying is coming in, but still, there's no real change going on. Maybe we're hitting some higher time frame area where we might have expected some volume. I don't know about on this chart, but it still doesn't really matter. we didn't get much of a drive up on all of that volume. If we're getting this kind of a move down on this volume, this is about the same level of volume, how come we don't get a move back up to 6 here, all the way up to here? Well, we're not. We're stopping at the EMA, and it's pretty clear that this is very congested in here. There's no ease of movement up. So it's a sell in here. Same thing at 8. Either one, either 8, you can sell. All the way down. Classic trend day to the downside. And this is how the oscillator and the Weiss wave work in a trend day down. Okay? Now, remember A? That's that. We could see that there was a little tiny ABC on the 3,000 tick chart. Well, this is the 9,000. And there we are. It's the oscillator trade. And look at it's preceded again by that big wave down with that big downside volume. Very, very useful. Now, we'd be tracking this as we're trading off of the 3,000 tick. And you can see that this time frame is just a little bit too big for this market to be able to take trades off of. Okay, so we drop down to the 3,000 tick chart and we trade off of that. But we can see, I mean, if you can coordinate all these points here, here and here and here and here with the smaller time frame chart, it's just the 310 oscillator makes it easier to trade off of that. But we still want to be looking at this. And what we're looking at are the EMA just going, down on a really nice angle, the 16 average down, the 310 basically underneath 0 all day long, and the Weiss wave showing us supply is dominant in the market and the demand is basically minimal. Okay? That's the recipe for a very good trading program for trend days. Now, unfortunately, we don't get them all that much, a few times a month maybe. But when we get them, this is when we want to think about when we get them and when we're doing well with them, and we maybe we get in early on. Maybe we don't get in at A, but maybe we get in up here somewhere. And then this is the noon hour and we've got all this profit and there's not much here. Maybe we want to add on. We want to try to hold this core position. Maybe we've got a trend day by the tail here. So we want to hold on and we want to add to that position. We might add in here and maybe in here. On some of those pullbacks. I don't know. How many were there? We were looking before. There were 8 opportunities to go short here, plus A, 9 opportunities on this trend day down. So there's opportunity to go short there if you're looking at that. Now, we also want to look at the higher time frame even more so, and that's going to look like this. This is the 27,000 tick chart. And again, we see the same thing. The EMA is just going straight down. Price isn't even coming close to the EMA, right? Price is just not even coming close. So this time frame is telling us that it's not so good for trading off of, but it's telling us that the overarching who's in control of this market, and it's the sellers. And you can see it in the 16 average, the 310, and certainly in the Weiss wave as well. All right, a couple of questions. What's the wave size with the 3,000 tick chart? Good question. It is 0.075. So 3/4 of a point, and this is subjective. You could make it a point, you could make it a half a point. I use that for the 3,000 and the 9,000. And then usually for this, I go to a higher, I go to, it's usually 1.5 to 2 points. I'm still playing around with it. I haven't gotten it. That's the 27K. But I like to see bigger waves on this because it's a bigger time frame. Okay. Okay. So here we are. Where are we here? I take notes and then I forget because I want to make sure that I cover everything and then I forget to look at the notes. Okay, we're going to cut this one in half. So we've got an up move on this part of the day and then a down move into the afternoon. So let's take a look at both. Okay. And I want to coordinate this. Here's the 3,000 tick with the 9,000 tick, and this is the first half of the day. All right. So we had been coming down here. We hold in here. There's an opportunity for people to go long. We see at C a higher high over B and also over this little swing high here. We've got momentum coming up in the 310. The 16 has now pulled up above the 0 line. We see pretty good volume on the Weiss wave, and we saw diminishing volume on the move down here. Okay, suggesting that selling was drying up, and now we see buying coming into the market here. So this is demand, and supply is drying up. And so we're seeing demand overcome supply here on this move up. Okay, we push up to new highs and stuff. Now, I want you to look, before we start talking about where do we get in and all of that, I want you to look on the 9,000 tick chart as well. We had come down and look at this nice move up here in price up to the high of, I should have put C in, I'm sorry I didn't put that in. Okay, look at how the 310 is working. And then at D, as the market pulls back, the 16 average is still below 0, but it's starting to move up. Okay, and we're not seeing the kind of downside volume coming in that we saw earlier. This is probably climactic action in here. All right, and we're seeing now the EMA rolling up on the 3,000 tick chart. We're pulling back to 0, and we have no supply coming in. And then we get a reversal bar and an opportunity to go long here. Okay? So that's coordinating these two with the two charts. And Gajendra asks, is there only one parameter for the Weiss wave? No, there are a few different parameters, but that's the main one, is setting the wave size. When I say there are more parameters, so you want to set the wave size, and what the wave size is so let's say we're moving up on these price bars, okay? How big of a move down has to occur before the wave changes? So we've got a wave up. Now, how big of a wave down do we need to see before we go from up to down? So that's one adjustment that you can make. That's one parameter that you can input, okay? Another parameter is, do you want to use it on the high? Do you want the waves to run from the low of the bar to the high of the bars, or do you want to run them from the close? I've been using it, and David uses it from close to close, but you can go from low to high and make it a true swing wave. But we found that closes are just as good, and we like closes. But you can experiment with it and try the swings from lows to high as well. So in this wave, we would go from this close to this close, and then down to this close, up to this close, and down. So we wouldn't go all the way up to the highs and the lows. Another setting on this, it's not really a setting, but you can ask it to tell you how many minutes on each wave up and down, and it will print 15 minutes here and 3 minutes here, something like that. That can be useful, although I don't really use that function. And you can also plot the volume. This might be 30,000 shares or contracts, and this might be 10. Okay, something like that. And you can print that as well. So those are some of the parameters. Do you know what the wave method setting does in the Weiss wave? Nathan, that's a good question. I don't know. The retrace method. Yeah, I don't know. And I asked David that once, and he said he doesn't know either. So who knows what that is? Who knows? You would think since it sets, since it says 2, that there would be another setting, but for some reason there's not. Okay, what did I do here? Oh, I didn't do this part. The second half of this. Okay, so we made a high at E. If we go back up, this would be E here. Okay, and E over here. So now we're advancing now, and so look at what happens. We get F here. Suddenly we get an increase in the wave volume coming down, and we get the 16 average going underneath. So this would be like one of those aggressive type trades, but it is a little ABC. I don't know if you can see this. It might be a little difficult to see, but it is in fact a little 3-wave pattern here. And the Weiss wave actually picks that up. Here's A and B and then C. Okay. So if you had the wave drawing on here, you would see that as well. And it is a little upthrust pattern. The only thing is the EMA has not turned over, and the EMA is always going to be slower than the 16. The 16 average is going to move quicker, okay? And you have to, if you're going to use this, you've got to understand that, and you've got to make a decision, and that's why you want to pair it, I think, with the volume coming into the downside here. So that might be an aggressive trade for some folks. Clearly, however, H is not aggressive. There we go. We are now, the EMA is rolling over, the 16 average is under 0. This pulls back up above. We get the reversal bar. We don't have, don't forget this. Ease of movement down, choppy small ranges going up. Ease of movement down, choppy small ranges, low volume going up. Okay? And then we start to see shortening of the thrust in here. On the higher time frame, we can certainly see the market starting to roll over, and we certainly can see the ease of movement coming down. And also the volume, although it's diminishing, it's still head and shoulders above the demand volume. Okay, so again, coordinate this. Start putting together the two time frames, and you'll begin to see things more clearly, especially if you're going to use these indicators. And again, let me just emphasize again, go back to the basics that we started off with and learn that stuff first. Then you can use these indicators. Then they're, useful. But get to the point where you can see the structure and you can read what's going on with the higher highs and the ease of movement and the volume and all of that stuff. Okay. Here's another one earlier in the month, I guess. Again, it's the same thing. The EMA is coming down, nice 45-degree angle. The 16 average is below 0. For the most part, the 310 is below 0 as well here. The wave volume is strong. Okay? The wave volume is strong. And we get a move here at C, at D, at E, at F, at G. It just, we see this all the time. We see this all the time. And you want to train yourself to really get this good so that you've got, you can trade this. Now notice we get a little shortening of the thrust in here. We could draw a trend line in here, and we'd see that we're not making all that progress coming down. But look at the EMA, it's just driving down. It's pushing and pushing down. It doesn't start to flatten out until here. We see shortening of the thrust again here, and that flattening out suggests that we're getting close to the end of the trend, and it's coming into the noon hour, which is time. And also we get a high volume in here on this wave up. Biggest up wave volume of the whole morning. So, we know that there's going to be some sort of correction in here and maybe a change of trend. Who knows? But we're down all morning again. This is the other thing to look at, and that will help you with the shortening of the thrust in this area here. The higher time frame, it's just negative for all the reasons we've said. Okay, a couple of questions here. Do you use volume, up and down volume on a 5-minute bar? Is it helpful to know that information? No, I don't use that. It's a good question, Gajendra, and I don't use it. We've looked at it, and David looked at it, and we haven't. He's got other ways of looking at volume, but I think the basic wave volume is still the best. But we don't use the up and down volume. Craig says, in my experience, you should use close to close in the Weiss wave to capture the wave volume correctly. I think you're right, Craig. I absolutely do. Otherwise, you're going to be jumping all around. Also, the other retracement setting is a percentage retracement instead of points. Good. Thank you. So yeah, you can say, thanks, Craig, for reminding me that. So I'm using points here. And I think we forget this, but you can say I want to have a, half a point, 0.5% correction, or a 1% correction, or 0.25% correction. You can do it that way as well. And there's another one which uses an average true range retracement. I didn't realize that, but don't think that's in the current version. Yeah, you're probably right. I'm not sure, Craig, that he's actually ever shown me the average true range. I'll have to ask him about that. That's good to know. Thanks. Lars says, regarding what you were showing with us with the 310, is this how Linda Ratchke teaches it, or is it something you've developed? It's kind of a combination. Linda certainly will teach this, but uses it this way, but I'm showing you a few of my own little tricks in here as well. So it's a combination of the two. Good, I'm glad you like it. What about daily, weekly, monthly pivots? Sure, that still remains in play. Absolutely, Gerhard, absolutely. Yeah, I'm kind of just focusing on these little ways of using the oscillator. I'm not trying to, we're already now, what are we now? Almost 4 hours into this. There's only a certain amount that I can show, but you absolutely have to use daily highs and lows and daily pivots. We do that in deep practice all the time, and it's a crucial thing to include in your trading. Absolutely crucial. And you'll see things occur around daily highs and lows and those pivots. And then, we might hit a daily high, and we fail to go through that, and then we start coming down, and then this stuff becomes really useful, right? You understand what I'm saying? We can't break through yesterday's high or the 2-day high, and we start coming down, we start trending down. Well, now we got something, right? So, again, just coordinating this with the higher time frames. I'm not sure why I didn't put in G and H here. Well, maybe that. Oh, maybe that was the end of the morning session. Okay, yeah, that's right. I'm sorry, I forget what I put up here in charts. So go back just a second. Here we are. We ended H. All right. And we start to see a little bit of volume coming in. I put this in blue or purple, I guess. That kind of signals that the morning session might be over. And this is typical for the S&Ps. It tends to go into 11:30 or so, 12 o'clock, and then we will get a noon hour consolidation, right? And there we go. There we get it. And we get that consolidation. And we come up to I, there's an up thrust there. If we're on our game, we can sell that short. It's kind of debatable about whether or not that's a setup here on the oscillator. We do see pretty good volume coming in here, but no result off of that volume. We should see this go up higher. So probably there was a lot of selling in this. And if we jump over to the higher time frame chart at I, we get certainly the Weiss volume here. The Weiss wave shows no real pickup in volume On the higher time frame, we have that little up thrust in a downtrend, nice trade setup that we're aware of, and the 16 average is still underneath zero, showing a very weak trend, and the 310 is up above. So then we start moving down. Look at what happens. We pick up again in volume on the Weiss wave. We go back underneath with the 16 average, and we get a little, this is like a fall through the ice on a small time frame, and the oscillator picks up that bumping our head on the ice, and we got plenty of price bars in there to play with, and we can add the structure in, no question about it, but I'm just kind of focusing in on how to use this thing. And you don't need to do anything else with this. I mean, K and L, they're the same trades. They're no different here, okay? And, it kind of helps you. It gives you that sort of that little eye candy, or that little chart jewelry, as some folks would say. But, is this, should I wait until we come all the way back up to this low, or are we just so weak that we're not making it? Well, this kind of helps tell you. Okay, we're at a time the entry. All right, and I had to do one. I think this is the tick chart that was the extra tick chart. I think I forgot this one. Forgot to put this one in, but it's the same story. We start rallying up. We get the 16 average is above zero, and it's pretty much above zero all day. We get the pullbacks in here. The green, it's a little dwarfed by this kind of volume, but the green volumes are bigger than the red, so the up volume is stronger. We get this big long wave up. It's grinding, and that also will happen intraday. So that's why the higher time frame to see what's really happening is good. You can see that the EMA is just going straight up. The 16 average is up all the way. It gives us two trades in here. B is over here, and A is down in here if we're up that early in the morning. But certainly you're expecting the move to continue. And then, you can see up here we get, if we were drawing a trend channel in here, we were overbought. We get still, we might be thinking, okay, we want to take a trade because we just, we've got that endowment effect and we expect the market to go to the moon. But look at what happens. The Weiss wave shows us big volume coming in. This thing, for the first time, we've been all day long, we've been up above zero for the most part, and now we get the biggest move down. We don't want to touch that to the upside anymore, not at all. Okay, and then the EMA flattens out as well. So just little ideas. With the, okay, a couple of questions here. Let's say, it's pretty easy to code the 310 oscillator. Yeah, it's very easy. I've got it for TradeStation. We can send it to you. Just drop me an email. Although I'm going to be a little tardy on that because I've got to go to England tomorrow. But I'll ask Helen to set that up for us if you guys want it. How will your deep practice schedule be forward during the summer? I'll talk about that in a minute. The RSI, the 2 below 1 on the 3000 tick chart is also a strong buy signal. That could be, Lars. I don't really use that. So that could be. That could very well be. And here's today, by the way. Up until the time when I stopped trading and prepping for this, and I think we had one last signal here, and I think the market still went further south before the noon hour, and I haven't really looked at it since then. But you can see that on the 27,000 tick chart, we get that A, B, C up thrust in a downtrend. We've been moving down. You can look at the higher time frames for that. And, this just picks it up nicely. We expect from this kind of a setup a new leg down. So now we combine this with this, and we just trade short, okay? Until we're told not to. Until we're told not to. And it's the same kind of setups over and over and over again. All right, so let me just do a quick summary here. We've talked about the characteristics of trends. Please go back to that. Don't just focus on, I know these indicators are cool and what I'm showing you is pretty good stuff. And it is good stuff. There's no question about it. But don't just focus on that, please. Understand how the markets really do work, and look at structure and look at the price movement and the volume and all of the things that we talked about. We talked about several ways to enter and exit. It doesn't almost really matter where we get in, just as long as we get in when we see this, because momentum is going to be on our side. We talked about what sets up those best trades, the jump across the creek and the fall through the ice, because it gives the opportunity of the market to go sideways for a while for accumulation or distribution. We talked about climactic action, shortening of the thrust, overbought and oversold when the trend is over. We talked about the first higher high and first lower low trade setup, one of my bread and butter setups. And then the what we call choice trade setup, something that's even a little bit better than just straight up pullbacks in a trend. Those are the springs in the upthrust that set up against support and resistance and show that ABC corrective pattern. Really look for this. This is good stuff. And all this stuff is good stuff, but this is good stuff. You can coordinate it with the higher time frame. We talked a little bit about doing that. And then we talked about using the momentum and Weiss wave and EMA as real trading tools. But again, coordinate that with this stuff. Okay, coordinate that with this stuff, and then you won't be, jumping in and out of the market and damaging yourself and your psychology about how to use it. You want to use this and this as support for what we talked about in the very beginning, the basics. Everybody that I know who are good traders, and everybody I know who are good athletes and good tennis players and good skiers and all that, they stick to the fundamentals. They polish those fundamentals until they're bright and sharp and shiny. And that's this stuff here. This is the fundamentals. And that's what you want to learn first. Okay, and also you want to do some deep practice on this. I said that you listen to this even though it's gone on for several hours. Just listening to it is not going to make you a great trader. You've got to practice that. And you can do this on your own, and you need to do it on your own. But you can also join us. We do it on Thursday nights at 8 o'clock. And I'll be off the next 2 weeks through July 5th. But Thursday, I think it's July 12th, we're back at 8 o'clock. And we'll continue on Thursdays throughout the summer and into the fall and the winter and so on and so forth. And basically what it is, it's a walk forward, bar by bar, deliberate practice. Okay, we're trading in a deliberate way. We're assessing, pretty much each bar as it goes along. And we've got a good group of traders in deep practice, most of whom have been there from the beginning, and we've gone through 60 sessions now. And if you join, you get you'll get access to the last month's worth of deep practice sessions. So it's pretty cool. We go through various markets. We've been working on the bonds lately, but we do the S&Ps. We do day charts, weekly charts, the tick charts, all of that. We even do a little bit of trading psychology as well. So if you go to my website, you'll see it right here, Deep Practice with Dr. Gary. You can click on that, and that'll take you to the information page, the details, and you can register there. That is as much as I can do tonight. So I want to thank you all for coming to this webinar. It's really a privilege to talk to everybody. And certainly I'll address any questions that we have, but I just want to say thanks a lot. I really appreciate you all, your interest in my work. It really is an honor and a privilege to do this with you all. Okay, good. Long session. Yeah, sorry, Amy. I apologize for that. Great, Eileen. Thank you. Tiny bit of confusion. ABC correction seems to be conflicting to the higher high and higher low setups. Yes, Tom. That's not really... It's not a surprise that you're confused about that. You do need to study it, but think about this. When we are in a downtrend, the odds favor that the ABC is going to be corrective. Or when we're in a good trend, the odds favor the ABC will be corrective. Okay? Think of that while you're studying this. Okay? There will be times when the ABC goes to D, E, and F and we get stopped out. But those times are relatively few. The ABC is a very good corrective move in a strong trend, and that's what you want to be thinking about here. Okay, good. All right, let's see. Good. I'm glad everybody likes this. Thank you, Tong. Appreciate those comments. And Richard and Gary and Lars, appreciate that. Gerhard, thank you. And Paul. Let's see. Darren, thanks a lot. Appreciate that. Augie, same thing. Glad you enjoyed it, David. Keen for the deep practice. Okay, Mark. Yeah, join us. I hope to look forward to it. And yes, it is all recorded too, by the way. Glad you liked it, Laura. And Tom and John. Glad. I hope I answered your question. This was beyond great. Thanks, Eileen. Appreciate that. All right, and Gajendra, thank you. All right, everybody, thank you very much again, and we'll sign off, and I hope to see you in deep practice. Take care, everybody. Bye-bye now.